Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, January 12th, and today's market news is the referee getting investigated mid-game?
Nothing says stable economy like the central bank chair checking the mailbox like it's a horror movie. Is this one of those weeks where my index fund needs emotional support?
Story 1. Reports say Federal Reserve Chair Jerome Powell said the Fed was served grand jury subpoenas from the Justice Department. Markets read that as a direct threat to Fed independence, whether or not anything comes of it.
Okay, naive question. What does Fed independence mean in normal person English? Like, is the Fed basically the thermostat and someone's trying to grab it midwinter?
That's a good analogy. The Fed is the thermostat for money, setting interest rates to balance inflation and employment. If investors think politicians can yank the thermostat whenever it's inconvenient, they demand a risk premium, weaker currency, higher long-term yields, and more volatility.
So the market is basically saying, if the thermostat is getting subpoenaed, we're charging extra for the house. Love that for us. What moved first?
Story 2 is the immediate tell. Safe havens benefited. One market wrap said gold breached $4,600 an ounce, and silver jumped over 5% to a new all-time high as the dollar dropped and stock futures tumbled on the Trump-Fed feud.
Gold at $4,600. At that price, my jewelry box is basically a hedge fund. But why do gold and silver pop when the dollar slips? Explain it like I'm budgeting in a checkout line.
Gold is priced in dollars globally. If the dollar weakens, it often takes more dollars to buy the same ounce. Plus, investors buy metals as a hedge against policy uncertainty and inflation risk. It's basically like buying a spare generator when you're worried the power company is getting politicized.
So gold is the generator. Silver is the generator that also thinks it's an industrial tool belt? Because silver can be a chaos hedge and a factory the man story, right?
Exactly. Silver has monetary haven vibes, but also industrial demand sensitivity. Actionable takeaway? If you're thinking about hedges, size them like insurance, small enough that you don't need a perfect entry, and diversified so you're not all in on one panic trade.
Don't see a plus 5% silver candle and immediately refinance your personality into bullion. Got it. But what about regular people? Does this Fed drama hit mortgages and car loans?
Over time, it can. If markets price more political risk into U.S. assets, long-term rates can drift higher even if the Fed wants lower rates. That can show up in mortgage rates, business borrowing costs, and eventually hiring decisions.
Speaking of stuff that shows up in my life instantly, gas. I saw oil holding near a 1-month high because of Iran protests. Are we doing inflation sequel again?
Story 3. Oil was steady near a 1-month high as unrest in Iran raised fears of supply disruptions from a major OPEC producer. Even without an actual outage, risk premiums get priced into crude when traders worry about shipping, production, or sanctions tightening.
So it's like airlines. The moment there's a storm somewhere, prices jump because everyone's bracing for delays, even if your flight is sunny. Except the flight is my grocery bill.
That's the mechanism. Actionable move for households. If energy spikes tend to hit your budget hard, treat it like a variable expense risk. Build a small buffer in checking, and consider locking in predictable costs where you can, like reviewing commute options or home energy plans.
Now let's talk about the spiciest consumer headline, the credit card rate cap idea. I saw banks getting hit, and one stock down big. Is my APR about to get rescued, or is this a trapdoor?
Story 4. Reports said Trump called for a 1-year cap of 10% on credit card interest rates, and bank shares sold off. One headline noted Capital One down 10%. The market's logic is simple. If revenue gets capped while defaults and funding costs don't, profitability compresses.
So it's like telling a pizza place, you can only charge $10, while cheese prices are doing parkour. The pizza place doesn't become generous. It just stops delivering to my neighborhood.
Exactly. A cap can mean tighter approvals, lower credit limits, more fees, or fewer rewards, especially for higher-risk borrowers. Practical steps this week? Check your current APRs. Prioritize paying down the highest APR first, and if your credit is solid, compare a 0% balance transfer offer. while reading the transfer fee and end date carefully.
So the hack is boring adult stuff. Know your rates, don't worship minimum payments, and don't assume a headline becomes a law before your statement closes. I hate how effective that is.
Quick recap, legal pressure headlines around the Fed can move currencies and long rates via independence risk. That fed into a safe haven surge with gold above $4,600 and silver up sharply. Oil held firm on Iran's supply risk fears, and rate cap talk hit bank stocks while creating uncertainty for consumer credit access.
And if you're listening thinking, cool, so everything is political and my wallet is collateral, same. But at least now you know what to watch. Dollar moves, long-term yields, and whether safe haven trades start looking crowded.
If this helped, subscribe and share the episode. And for your own plan, keep an emergency buffer, avoid variable rate debt where possible, and rebalance calmly instead of chasing the day's loudest candle. We'll be back tomorrow with the next briefing.